As we look at the board today on Saturday, June 27, 2026, the equity markets are officially closed for the weekend, meaning we need to establish our baseline using the final numbers from the most recent active trading session. BigBear.ai Holdings, Inc., which you know on the New York Stock Exchange by its ticker symbol BBAI, concluded its trading week on Friday, June 26, 2026 at 4 p.m. Eastern Time at a final closing price of $3.48 per share. Looking at the intraday price action from that Friday session, the stock experienced a volatile ride, hit an intraday low of $3.33 before finding a bit of late-day buying support to bounce back toward its closing level, ultimately showing a modest recovery from its absolute lows, but remaining heavily depressed compared to its pricing structure from just a month prior. While retail trading rooms are buzzing about whether this sub-$4 price point represents an absolute floor or a falling knife, the real surprise that most casual market observers missed happened at the recent annual meeting this June. Shareholders quietly voted to approve a massive amendment doubling the company's authorized common stock from 500 million shares to a staggering 1 billion shares. When a microcap tech firm creates the legal headroom to flood the market with twice as many shares, the immediate expectation from the trading community is that an aggressive, dilutive capital raise is imminent, designed to keep a burning ship afloat. But the underlying reality is far more complex because this authorization coincides with management aggressively clearing historical debt from the balance sheet and accumulating over $400 million in cash and liquid investments, indicating that this massive share expansion might not be a desperate survival mechanism, but rather a loaded spring for large-scale corporate acquisitions in the defense technology space. The general consensus surrounding small-cap artificial intelligence plays like BigBear.ai is that they are highly speculative, volatile vehicles that only move when retail traders get bored of trading megacaps like Tesla stock or Apple stock. The common narrative suggests that these minor firms lack stable revenue, possess no unique institutional moat, and are destined to fade away once the broader market excitement cools down. If you scroll through popular investing sites or check trending tickers on a standard individual brokerage account, the prevailing sentiment often dismisses BigBear.ai as an unprofitable entity that cannot convert corporate hype into hard contract revenue. However, challenging this mainstream skepticism requires looking at the structural shifts occurring within the federal procurement landscape. Unlike consumer-facing applications, national security procurement requires extreme technical validation and years of clearing regulatory hurdles. While the average retail trader assumes BigBear.ai is just struggling to find its footing in a crowded marketplace, the reality is that federal defense agencies are quietly entrenching this company into their long-term administrative systems. The widening gap between what the public perceives as a struggling penny stock and what the institutional data shows regarding multi-year contract backlogs creates a fascinating setup for patient market participants. To truly understand why the stock has been hammered down to the $3.48 level, we have to look closely at the intense trading volumes and recent price swings that have characterized the last 30 days of market action. Back in late May, the stock was enjoying a solid run-up toward the $5 mark, driven by sector momentum and high-volume speculative inflows. But June brought a severe correction, forcing the asset down by more than 34% in a matter of weeks. During this downturn, daily trading volumes regularly exceeded 41 million shares, a massive surge compared to the historical baseline levels for this company. This level of liquid turnover tells us that this was not just a quiet retail sell-off, it was a heavy institutional reshuffling. When looking at order flows through sophisticated tools like the Interactive Brokers platform, it becomes clear that automated systems and risk-averse funds were dumping shares to recalibrate their small-cap exposure amid broader macroeconomic uncertainties. Rising yields and sticky inflation numbers have made Wall Street less tolerant of businesses with negative adjusted EBITDA, causing a systemic exit from growth assets that lack current positive GAAP earnings. For retail investors managing their own portfolios through self-investing accounts or looking for basic investment help, navigating these sudden 10% daily swings can be incredibly stressful. Someone logged into their Fidelity mobile app or tracking their holdings through the main Robinhood app might see their position drop significantly over a trailing 2-week window without any apparent negative corporate press release. This disconnect happens because small-cap equities are often treated as collateral damage when larger institutional players liquidate positions to cover losses elsewhere or shift their capital into safer dividend-paying assets. If you analyze the broader market trends, you can see that when megacaps like an Nvidia stock capture all the available liquidity on Wall Street, smaller technology firms suffer from a severe capital drain. The money does not vanish, it simply migrates to the largest, safest tech giants, leaving companies like BigBear.ai vulnerable to high short-selling pressure and exaggerated downward moves on relatively negative catalysts. If you look at how people are building out their long-term wealth strategies using automated tools like Schwab Intelligent Portfolios or a standard SoFi robo-advisor, microcap defense tech is almost never included in the core allocations because the risk metrics are too skewed for an automated algorithm. These platforms prefer stable, highly liquid vehicles such as Fidelity ETFs or conservative Fidelity mutual funds to manage downside risk. This means the ownership structure of BigBear.ai is dominated by two distinct groups: large institutional venture funds that hold massive blocks of shares from the early public listings, and retail traders utilizing online investment accounts to chase rapid momentum. When these two groups clash during a market correction, the price action becomes incredibly jagged. Institutional block trades can depress the price within seconds, triggering stop-loss orders across retail platforms like the Robinhood trading platform or individual brokerage accounts at major firms. This creates a cascading effect that drives the equity down past its fair intrinsic value, which is exactly what we witnessed during the mid-June slide, where the stock fell from nearly $5 down to its current resting place near $3.50. Let's pause here for a quick community pulse check because tracking investor sentiment is vital when analyzing a stock with this much retail engagement. Comment below how many shares of BigBear.ai you currently hold in your portfolio, and let me know if you're actively buying this dip or if you're completely staying away from small-cap tech right now. Now, let's ground this near-term market turbulence by looking at what this business actually does and how its core operational layout functions beneath the stock ticker. BigBear.ai operates as a provider of operational artificial intelligence, machine learning, and advanced analytics, primarily serving the United States Defense Establishment, national security agencies, and highly complex commercial logistics enterprises. The core business model relies on building custom software solutions that can ingest massive, messy data sets from completely disparate sources, process that information through predictive models, and deliver real-time decision support for mission-critical operations. A great example of this is their proprietary Ask Sage platform, which has been gaining significant traction across various branches of the military and intelligence departments. Instead of providing generalized chatbots, they're delivering secure, localized language models capable of handling classified data to assist officers with tactical planning, supply chain mapping, and threat assessment. This is a highly specialized niche where standard commercial tech firms cannot easily compete due to the strict security clearances and institutional trust required by the Pentagon. When you look back at older financial reports and past performance, the historical baggage explains why the market treats this stock with a high degree of suspicion. The company entered the public markets via a merger with a special-purpose acquisition company, a structural pathway that left many businesses saddled with high debt, unrealistic revenue projections, and intense retail skepticism. In previous fiscal years, the firm struggled with flat top-line revenue growth, sticky operating losses, and a reliance on a few chunky government awards that made quarterly revenue highly unpredictable. For instance, looking back at historical data from past years, the company posted deep net losses, such as a $395 million net loss in a prior annual cycle, driven by heavy non-cash goodwill impairment charges and elevated selling, general, and administrative expenses. Investors who bought into the early public listings saw their capital erode as the stock plummeted from its all-time highs down into penny stock territory. This historical destruction of shareholder value weighs heavily on the current valuation multiple, as institutional analysts want to see sustained operational execution before they reward the company with a premium price-to-sales ratio. However, the historical strain contrasts sharply with the structural cleanup that management has executed over the past year. By systematically addressing their balance sheet obligations, the executive team managed to eliminate roughly $125 million of legacy debt, significantly lowering their interest expense burden and reducing the threat of a sudden liquidity crunch. At the same time, their gross profit margins have begun to repair